Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. Before we welcome Dimitri to the stage, let's take one last look at the disclaimer. And we're going to be talking about analyzing a call spread strategy with historical data this morning. All right. Dimitri Pargamonic, welcome to the stage, my friend.
Good morning.
How are you doing this morning, D?
Good, thank you.
All right. Let me share your screen. There's the Market Chameleon.
Good morning, everyone. And in this video, I'm going to go over a call spread, but let me first navigate to a symbol so we could set it up and go through an example. So on the search box, I'm going to type in a symbol. Let's just go to Google as our default. When you type that in, you're going to land on the Google's homepage, summary page. On the left-hand side, there's a menu. We're going to go to the option chain, click on options, and click on the option chain. I'm going to then just click on this menu to minimize it and expand our screen. And here the idea is we're going to set up a call spread. And when we do that, and we have a call spread that we may be interested in. One of the things we want to do is dig a little bit deeper in there and get some insights and be able to analyze it or do a little bit of research initially to see, well, how is this call spread currently priced relative to historical data, historical stock moves, historical implied volatilities, so we could get a sense of, is the pricing on a higher end, lower end, how much risk do I potentially have, potential reward. So these are typical questions as you're going through and doing research that you may want to ask, just like you would do if you're considering investing in, let's say, a rental property. Well, if you're looking at a property and you have this price, right? You're like, here's a rental property for sale, $200,000. Okay, so that's the market price, just like we do get it from an options chain. And I'm gonna just kind of come out here. Let's just say we're looking at an August 29th option chain, right? And we have these calls and puts, and we're looking at prices. Well, how do we then analyze this? And we got this market price. We have this house, 200,000, but then certain questions may pop up to help us make a better decision. Like, well, how much can I rent it for? What are the taxes on it? How much is insurance? You're going to ask, well, is 200,000 a fair price for this rental property? How much is a similar rental property in the area, and so forth? So you have all these questions you're going to want to go through to make sure you're making a sound, reasonable, rational, data-driven decision. So the idea here is, well, let's say we're looking at a call spread and we're going to line it up, and let's create a bullish call spread. So what's a bullish call spread in Google? Is you're buying one call option. Let's do a 205 call. So over here we see 205 call. We're going to buy it we're going to click on the offer, and this brings up the first leg of our call spread. Since I clicked on the offer, it defaults to buying an August 29 205 call for $5.05. We could change these parameters, but when you click on it, it auto populates the market, the ask price over here, the buy side, because you're clicking on the offer, and the details of this option. Now, a call spread involves buying one call and selling another call in a different strike in the same expiration. Since we're doing a bullish call, we're gonna sell a call that's at a higher strike. So let's say we do let's go to the 215 call. I'm going to click on this bid. And now you see it lines up. Sell August 29, 215 call for $1.18, which is that's the bid price. Again, you could change these, but let's leave it at these displayed prices. And we have this strategy now that we're considering. It's either trade or investment you're considering doing, and we could run these prices to see what it would cost. But then we want to do research to perform more analysis on it. Just like I gave you an example, if you're any type of investment you're considering, you're going to have more questions. And let's see if we could get some insights and answer some of those questions through our analysis. So I'm going to run this analysis, click it here, and then it gives us some summary statistics, graphs, ways to start our analysis. Here, it tells us that if we did it at these prices, bought it at 505, sold it at $1.18, it would cost $3.87. Okay, so that would be the cost of it. And now we have the price, right? That's the price we're trying to evaluate. Well, just like if you're looking at a price of a business or rental property, well, let me see if this makes sense, if it's in range of similar risk assets. How do I do that? So up top, we have initial two ways to run that evaluation quickly. One is we could look back in history how Google stock moved, okay, based on the stock movements, where we could line it up with 5 trading days, similar circumstances. There's no earnings expected between now and August 29th, so it's going to look at non-earnings periods, and it's going to look at, based on the movements of Google over a 5-day period, give me, the average theoretical value of this spread. So sometimes if the Google, stock went down, it could be worth 0. Sometimes if it went up, this call spread could be worth as much as $10, sometimes in the middle. So what it will do is go through our default settings and say, on average, based on Google's stock price, stock distribution, right, of returns, this spread had an average value of $3.97. So at 387, it's kind of like within its average. It's close to it, right? You're not going to get exact, especially you could change the data around and get different figures, but this is an initial starting point, which in theory, it is 10 cents below our average. Well, since we have an average, we also want to know, where does this 387 price lie within our distribution of returns. So, if this is average, some could have been $15, some 0, some could have been 4, so we took an average of all of them. So we want to see the historical win rate. In other words, how many times did in our study, in our observations, how many times did Google move in a way that made this 387 look profitable? In other words, like that the stock moved enough that this would be at the end worth more than $3.87. So that's 48% of the time. Okay, so historically, whatever Google needs to move now, the percentage move to make this spread worth more than 387, that happened 48% of the time in our observations, which is telling us it's not out of the, it's almost 50-50. The Google moves up, it moves down, but based on history, it's like almost a 50-50 that this could be profitable or unprofitable. So that's using the historical stock returns. Another way we could look at it is, how does Google options usually priced in a similar circumstance? So if we looked at historically with 5 trading days to go, with the strikes this distance away, and we looked in our database where the implied volatilities were, on average, where would this strategy get priced? And here it says the average was $3.56. So this looks a little bit the average price lower. So the current market price is a little bit higher than that, which is 31 cents lower. The median price is 352, meaning half of the spreads in our historical database were priced below 352, half of them were above 352. And the range on the low end and high end was 304 to 497. This is, so we could see that this is in between the range, it's not on the low or high end, it's somewhere in between there. So these are two different ways that we could quickly just get an assessment. Where are we right now? Where's the market price relative to some theoretical values that we could default to as our initial starting point? Okay, you could change these parameters around if you wanted to. If you go to the distribution Theo, you could go in further and then open up these settings, and you could change the number of years in your study, include or exclude the earnings, and use these. But I'm not gonna get into this part right now because I don't have time, but I'm gonna come back to the summary, and these are our defaults. So a question, that I get all the time, well, which one do you look at? It's not which one do you look at or ignore one and only look at the other, because these are different methodologies that answer different questions. For example, if I took a rental property, I could create a valuation based on different ways. One, I could say, well, give me the average price of similar rental properties that sold. I could take the average of prices that they sold at and then come up with a valuation. I could also say, well, forget that, just tell me what the rent is, and then based on the rent, if I could give it a cap, I need a capex of 10 or cap rate of 10%, then I could, and if it's $20,000 in rent or $200,000 to me, something like that, I could create a valuation that way. Or I could, create a valuation by saying, well, if I bought a piece of land and built my own similar house, how much would it cost? So these are different methodologies that gives you a different answer based on that methodology. Okay, so when you look at it, there's no one right and then the other ones are wrong. You're looking at different ways to compare how far away are we from any one of these methodologies. Okay, where are we in the realm of, does the price currently blow through everything that any way we look at it? So that's the idea there. You're looking at it from different perspectives, different methods of valuing. Coming down a little bit further, here we see that the current market price is 375 bid, 387 offered, and the midpoint is 381. This is a quick way to look at the market liquidity, the market spread between the displayed bid, displayed offer, because when you're trading, right, when you're trading and you have a market, where people are displaying bids, where they want to buy, where they want to sell it, and you want to know how wide apart they are, and where you could potentially get price improvements. So this is a market where it's more than 10 cents wide, right? 12 cents wide. Well, that gives you room to try to get a better price. Even if you like the spread, you don't necessarily need to go right away and pay the 387. If the midpoint's 381, that's 6 cents below. You could try to, it shows that there's potential price improvement because there is a spread that's wide, and something to keep in mind, especially when you have wide spreads, the liquidity of that spread, in case you need to exit it. I'm going to stop there, Will, because this goes into like risk sensitivity and price charts. Maybe we'll continue on it tomorrow, but I'm going to throw it back to you at this point.
All right. Risk sensitivity and price charts tomorrow. Awesome job, D. Thanks for bringing the first webinar of the week to the Chameleon community. We'll see you tomorrow. Thanks.
All right. Thanks, everyone, for joining. Stay safe. Have a great trading day, and hope to see you guys tomorrow morning.
All right, D. We'll see you tomorrow. Thanks, buddy. All right, everyone. Thanks for joining the Market Chameleon webinar. We will look at those two items tomorrow within the screener. Everyone, remember, follow us, like us, thumbs up if you're on YouTube. Always appreciated. We are doing a live webinar at 4:30 today with Ryan, who's going to be looking at some options ideas that he sees during the trading day today. And he's from Options Robot, so we'll do that at 4:30 today. Hopefully the email gets out to everyone. Everyone have a safe, great trading day. Remember, like and follow us. Have a great day.